Hey there and welcome. You ever look at some huge publicly traded company and just wonder who's actually running the show? I mean, who really owns it? Well, today we are going to cut right through all that noise and answer that exact question. We're going to peel back the layers and figure out who sits at the top of the investor pecking order.
So, let's start with that big question. Who really owns a company? It sounds super simple, doesn't it? But, the answer has a lot more to it than you might think. It's not just about who gets a slice of the pie. It's about what kind of slice they get and what kind of power comes with it. And that's the puzzle we're going to solve together.
Probably the easiest way to picture a company's financial setup is to think of it like a pie. This whole pie is sliced up for investors into three main chunks. And trust me, they are not all created equal. You've got debt, you've got preferred stock, and then you have the one we're going to start with, common equity.
All right, so looking at those three groups, who are the real bosses here? Let's go ahead and unmask the true owners and figure out exactly what gives them that title.
And the answer is, drumroll please, it's the common equity holders. That's right. If you own a share of common stock, congratulations, you are a part owner of that company. But why? What is it that makes them the owners and not the other guys? Okay, so here's the absolute key. Ownership is all about control. See, common equity holders are the only ones who get voting rights. And with those votes, they get to elect the board of directors. And guess who the board hires and, more importantly, fires? The CEO. So if you follow that chain of command, it's the common stockholders who are indirectly calling the shots. That's where their power comes from.
Now, for taking on all that risk of ownership, these common equity holders can get a piece of the company's profits. This payout isn't called interest or anything like that. It has a special name, a dividend.
This brings us to a really important question. If you're an owner, does the company legally have to pay you that dividend? Is your slice of the profit actually guaranteed? And the answer is a big, fat no. Dividends are completely up in the air. A company might decide to pay out a massive dividend one year, a tiny one the next, or even skip paying one for years if they want to plow that money back into the business. And here's the real kicker. The owners, the common stockholders, they can't sue the company for not paying them. That's just the risk you take for being the boss.
Okay, let's move on to the next slice of our company pie. This group, they're not the owners, they are, simply put, the lenders. But don't let that fool you. They have a totally different kind of power, a different kind of clout.
So, these are the debt holders. You'll also hear them called creditors or bond holders. Think of it this way. They've loaned money to the company, kind of like how a bank gives you a loan for a house. They don't own the house, but they have a very strong claim on it if you stop paying.
And just like with any other loan, their payout gets a different name. It's not a dividend, it's interest. It's basically the fee the company pays them for getting to use their cash.
So let's ask that same exact question we asked about the owners. Is this interest payment guaranteed? Does the company have to pay up?
Oh yeah, absolutely yes. Interest isn't a suggestion. It is a fixed legal obligation. It's right there in a contract. If a company misses even a single interest payment, the debt holders can sue. In fact, they can force the company right into bankruptcy. Now that's the clout we were talking about.
This is where you can really see the difference between these two groups. It's all about the trade-off. See, the owners get control with their voting rights, but their payout, that dividend, is totally variable. On the other hand, the lenders give up all control, but in return, their payout, the interest, is fixed and legally guaranteed. So it's power versus certainty. That's the name of the game.
And all of this brings us to the real heart of the matter, the pecking order. Because when money gets tight, or even worse, when a company actually goes bankrupt, there is a very strict hierarchy for who gets paid. And the order is pretty simple, and it is rock solid. First in line, you have the debt holders. Their interest has to be paid, period. Then you've got this interesting group sandwiched in the middle called preferred stockholders. And who is at the very back of the line, only getting paid after everyone else has gotten their share? You guessed it, the owners, the common equity holders.
You know, there's a fantastic financial term for being at the back of the line like that, because common equity holders only get what's left over after everybody else has been paid. They are officially known as residual owners.
And residual is really just a fancy way of saying the leftovers. Now, if the company's doing amazingly well, those leftovers can be huge. But if the company goes belly up and all its assets are sold, the debt holders get their money first.
By the time it's the common stockholders' turn, well, there's often nothing left at all.
So why does any of this matter to you? Well, because this whole structure, this whole pecking order, it reveals the fundamental balance of risk and reward that pretty much underpins the entire financial world.
This chart really lays it all out, doesn't it? Just look at that inverse relationship. The debt holders, they have the highest priority claim. They get paid first. But that safety comes at the cost of having no control. Then, as you move down the list to common equity, your claim becomes residual, just the leftovers, but your control becomes absolute through those voting rights. You are literally swapping safety for power.
So if you remember one thing, remember this trade-off. It's a fundamental rule. The safer your investment is, meaning the higher your priority in that pecking order, the less control and potential for huge gains you're going to have. If you want the control and the chance to hit a home run, you have to accept the risk of being last in line.
And that kind of leaves us with one last question for you to chew on. When it's your money on the line, what's more important to you? The safety and security of being first in line to get paid, or the power and the massive potential that comes with being the owner? It's the core choice every single investor has to make.